Hello and welcome from snowy Michigan on this cold February day. Did you know that the center now serves clients in 40 states? Well, we hope this webinar finds you somewhere with warm weather and sunshine. For those of us listening in the Midwest, we see you and stay strong. My name is Lauren Adams, and I'm a partner and certified financial planner here at the center. It is my pleasure to welcome you today to our annual investment event, where you get to hear the center's latest thoughts about markets and the economy and what it means for your portfolio and financial plan. Many of you may be brand new to us, or perhaps you've been a center client for 30 years or more. Well, you're all important stakeholders of our firm, and we wanted to share a few updates before we get started about the latest happenings at the center. The center now serves over 1,000 families and manages $1.6 billion in assets on their behalf. We have 30 team members, and we spend a lot of time focusing on workplace culture to make this a great place to work. We think happy employees translates into a better experience for you, our clients, and it also allows us to attract top advisor talent. We now have 15 certified financial planners. Yes, a full half of our team now carries this gold standard in the financial planning field. Since our founding in 1985 by our three founders, Dan Boyce, Marilyn Gunther, and Estelle Wade, we are now on our second and third generation of ownership, and we count 8 partners among our ownership group. So with that quick center update, let's turn to our main event. First, you'll hear our feature investment presentation, and then you'll have the chance to hear from one of our senior financial planners who will talk about some important legislative updates affecting the financial planning world. Now, I'd like to introduce you to our keynote speaker for today, partner, director of investments, and CFP professional herself, Angela Palacios. As director of investments, Angela chairs the firm's investment committee, which is made up of senior financial planners and portfolio managers at the center. She leads our investment department, which is responsible from everything from account trading to investment research. Under her leadership, our team has been able to reduce the average internal expense of portfolios by 70% over the last 10 years. She was recently named a notable woman in finance by Crain's Detroit Business. Welcome, Angela Palacios.
Thanks, Lauren. And I'd like to thank everyone for joining us today. We're going to be discussing what occurred in markets last year and looking ahead at our market outlook for 2024. I'll do a quick economic update, and after that, Michael will join me for some financial planning updates, as Lauren said. I'll put my contact information up on the last screen, so you have that if you'd like to reach out with additional questions afterwards. So the changing of the calendar is a natural time to reflect on the previous year end and imagine what could be different in the new one. Recent years have ended up differing substantially from consensus expectations at the start of the year. For example, according to media experts last year, we should be in our bunkers trying to survive one of the deepest recessions ever right now, I feel like. Investors could have been described as pretty pessimistic heading into last year, with the S&P 500 index having finished 2022 down almost 20%. Expectations heading into 2023 were suggesting the most anticipated recession ever. And as you can see that while markets had some ups and downs last year, across the board, we see positive numbers. So what happened that everyone got it so wrong? Well, if you think back to what we were looking at for the year, the call for recession was actually pretty logical. Interest rates were still being increased drastically, inflation was still very high, and it seemed like companies and consumers would start tightening their belts because of that. However, inflation came under control quicker than most imagined, and the consumer continued spending very strongly, which continued to fuel growth. So if you couple that with some AI hype, you had a very good year, especially here in the US. So thinking back to the thoughts about recession that really didn't seem to happen last year, I wouldn't be telling you the whole story if I didn't mention that we have seen some recessionary characteristics kind of rolling through the economy the last couple of years. but it's happened sort of one sector at a time, so it hasn't culminated in that traditional recession call. I like this chart because it leads us into an important reminder that no matter what's happening, the US markets generally go on to make new highs. Whether it be through a pandemic, assassination, or wars. This chart has a bunch of red dots on it that represent the date that these major headlines occurred, and you can kind of read through some of those. I like to call these yeah, but moments. These are times when we're telling you to keep saving, stay calm, remain invested. I hope all of that sounds familiar to you. But at those times, you might be saying, yeah, but the US debt was just downgraded, or that's never happened and that's pretty scary, or there's this virus called COVID-19 shutting the economy down. Maybe it's different this time and we should sell. And you can see that some of the time markets contracted for short or even lengthy periods of time before resuming that upward march. And sometimes, at times these headlines contributed to essentially nothing in the markets. They completely shrugged the news off. Last year was one of those years where we had rising interest rates, we had bank failures, fiscal concerns, and yet the market continued upward in the face of all that worry. You never know which black swan event like these are going to happen and when. And we don't know if the market's going to completely shrug it off or be impacted in the short run. But we do know that the world hasn't ended so far. So when you're getting worried, try to stop and remember this picture. It's kind of a great reminder that we usually come out the other side. Thinking about 2023 again, did it feel to you like last year was volatile? When I think of volatility, I think about the number of days during the year when there are big price swings up and down. When measured that way, 2023 was actually about half as volatile as 2022 and in line with a normal year. On average, we have about 62 1% movements in the S&P 500 in a year. Last year, you can see we had 64, but in 2022, we had 122. In 2023, not a single day notched with a 3% or greater swing in the market. In spite of regional bank failures, geopolitical tensions, and political brinksmanship in the US day to day, it was quite a quiet year. What's interesting is that in the face of all of these headlines, the market performed very similarly to the average pre-election year market. The light blue is the path that the S&P followed last year in 2023, and the dark blue is the average for these years in the election cycle. It amazes me how often, history rhymes. Concentration of returns has been a big headline for many years. You can see that Apple, which are the gray bars on the right, has long been the largest stock in the S&P 500. And with that, the heaviest weighting has had a lot of impact on returns. I think it's important to see that concentration has been normal for years, but it is growing recently. I think it's interesting also to see over the years who the leaders have been. Many household names we still know well, like IBM, ExxonMobil, GE, and Microsoft. But last year we had stocks beyond just Apple driving returns. We had what the market or the media is calling the Magnificent Seven: Apple, Microsoft, Google, Amazon, NVIDIA, Facebook, Tesla. The media company, companies love to find a catchy name for this group each year. When you put the returns for 2023 of just these 7 companies together, they made 112%, while the other 493 companies in the S&P 500 were only up about 15%. So it's important to remember that diversification is an important tool for investors over the long run, because those same 7 companies in 2022 were down 46%, whereas the market was only down 18% overall. And when you look at something like more conservative, like dividend paying stocks, they were down even less than that in 22. So as we head into 2024, we think It's likely that returns may spread out a little bit more, not be so concentrated. But at the end of the day, what you pay for a company matters in the long run. And there are still many interesting buys out there beyond those 7 kind of richly valued companies. This brings me back to diversification again. You're going to hear this a lot in this presentation. It's there to reduce risk. Over the past 2 years, if you own just those Magnificent Seven stocks rather than the S&P 500, so the blue bar versus the gray bar, you experience 62% more risk or bigger price fluctuations than the market. Whereas those dividend payers resulted in less risk than the S&P 500. When our investment committee constructs portfolios, this side of the coin very much matters too. We aren't simply looking for returns sake. We're looking to get you returns that you can stomach over time. This may mean giving up on some upside during a strong up year, but hopefully results in giving up on some downside in down years. To do that, we look at asset classes beyond just US large cap. Yes, our US large cap is capturing this upside, but the balance of the portfolio needs to work alongside this piece to create a better outcome for investors over the long term. Which brings us to bonds. The biggest story of 2022 continued to make headlines in 2023. The Federal Reserve increased interest rates in pretty drastic fashion to fight inflation that they caused with cash infusion into the economy during COVID. Unlike 2022, though, there were fewer rate increases in 2023 and less drastic rate increases as we started to see inflation coming under control. Rates still increased by 1%, though, which impacted fixed income returns for much of the year. As the interest these bonds were earning increased and the outlook shifted to a path of potential reductions in the future, we saw bond markets rally late in the year to ultimately end in reasonable positive territory. Now we're earning much better rates on our CDs, money markets, and bonds, and I'm sure you're feeling that too at the bank. So continuing to highlight diversification in our portfolios, we'd be leaving a major part of the world out if we ignored talking about international investments. Developed international stocks weren't as flashy as returns for the US last year, large cap stocks anyway, but 18% is still a return we're celebrating. This chart underscores why we look internationally, as almost half of the equity market opportunity set is found outside the US, the US being that dark gray area and the rest of the world, the other pieces of the pie. So this slide talks about, that over the last 50 years, there have been different regimes of US versus international outperformance, and they tend to run for long periods of time. In other words, that outperformance comes in waves. So after a long period of US outperformance, which is the gray areas of this chart, it's worth considering whether we may be transitioning to a new wave. You can see that it hasn't been so dominant the last couple of years. So indeed, the stars may be aligning for international to take the baton from the US over the next decade. We don't know. We want to be allocated to both areas. Some, I guess, tailwinds behind international investing is cheaper equity valuations, cheaper currencies. So maybe it's time for my favorite color to take over in this chart, purple. Looking ahead to 2024 now, let's start kind of at the highest level. When constructing portfolios, there are a lot of decisions that need to be made. First comes the work that you do with your financial planner, and the most important work. Your financial plan is your baseline and gives us an idea of what types of returns you need to be seeking and when you need to use your money. Through discussions with your planner, they help you to decide how much risk you can stomach to achieve that return that you need. Some might be comfortable rolling the dice, knowing that some years might be really rough, but you'll continue to invest through those times. And some might not be comfortable with that. I think this chart does a good job of showing what that can really mean. It would be even better to take this chart and turn it into dollars and cents rather than percentages, so we'll do that. For example, if you think you want to shoot for higher average returns, might seem like the thing to do after a year like 2023, and try to go for 100% equity allocation? Are you comfortable losing 37% in a given year? Because that's what's happened in the past. What if you had a $1 million portfolio? That means you would watch it go down to $630,000 in 1 year. Is that okay with you? Can you continue to hang on with the hope that it'll go back up? Because that's what you need to do if you're going to be that aggressive. Remember the chart that I showed you kind of way back at the beginning of the presentation with all the headlines and showing the market continuing to climb over the years in spite of that? Well, that chart reminds us that those times have never lasted, right? So you have to hang on when you have a heavy equity portfolio. The end of the world only happens once, and we're still here and investing, so it hasn't happened yet. So that's how you have to think of your portfolio. There are going to be some extreme down years, some extreme up years. What can you tolerate? This also shows us that there's a point where risk stops diminishing by just adding bonds to the portfolio. Somewhere around 50, 60% bonds, we stop reducing kind of that downside risk. But it's also important to remember the limitations of data like this. This is just a simple portfolio of the S&P 500 and a core bond index. There's no further diversification in this chart, when in reality, there's a whole world of possibility to add diversification benefits beyond just this chart. So, looking around the world, let's turn the conversation into some more forward-looking commentary now. When trying to decide how to allocate assets, it's more important to understand your starting point. Valuations are one way to measure a starting point, and that's what we're looking at here. So how cheap or how expensive an asset is. This chart shows how equities were valued toward the end of 2023 last year. And you can see that the US is kind of the most expensive market in the developed world economies, trading at about 21.5 times earnings. This is normal for the US to be a little bit more expensive than the rest of the world because growth in general has been higher and our dollar has been stronger. But you can't deny that valuations look somewhat more tempting in other parts of the world, like Europe and the UK, a little bit cheaper. When you dig into like emerging markets, India is pretty expensive, but as a whole, valuations are pretty attractive there as well. Dividends are another gauge of potential return. Investors are often surprised to learn that dividends are paid at a higher rate outside the US, and dividends can make up a significant amount of our returns. So it's important not to ignore them. For these reasons, we think it's important also to continue to diversify our US investments. Look at the US. Currently, dividends are sitting right around 1.5% for the S&P 500. Not very compelling when you look at other areas of the world with much higher dividend yields. But what I want you to take away from these last three charts really is to understand why we aren't giving up on international when constructing diversified portfolios. So some of you may have heard that there's an election this year. There's always this debate as to whether Democrats or Republicans are better for the market. And this is a very simplified kind of extreme look at this, but it gives us a snapshot of how markets have performed under different presidencies. So the winner and the best strategy is, you probably guessed it, just remain fully invested at all times. That's the green bar. Versus if you were just invested when a Democrat's holding the presidential office or when a Republican is holding the office. If you zoom in and just look at the red and the blue, it may seem counterintuitive that markets do better when a Democrat's sitting in that seat. Again, the chart doesn't necessarily tell the whole story here. You have to kind of read between the lines of the data and look at the macro backdrop of what was happening in those numbers. It's actually a pretty simple explanation, as Republicans held the office in 2008, which was one of the worst years ever in the market. If you remove that one anomaly, the numbers are actually about the same. It doesn't matter who holds the office. When you dig a little deeper into the data, you see that markets tend to favor the most when there's a split in power. So not the same party holding everything, the presidency, the House, Senate. Basically the market likes status quo when it comes to DC. And the macro backdrop tends to be a bigger driver of what is actually happening in markets, more so than politics. This is just another way to look at the same concept. The red areas are Republican presidency, the blue areas are Democratic presidency. The line is the growth of $1,000 invested in the S&P 500 way back at the beginning, back to 1933. And you can see that as a whole, markets trend upward regardless of who sits in that seat. So now I'd like to dive into some election year myths. This section is really directly influenced by questions we hear from you. So myth number one, markets do poorly in an election year. Reality, returns in election and non-election years usually aren't all that different. We took a look at how the S&P 500 has fared in both instances going back to 1928. And stocks return on average 7.5% during election years, compared to 8% during non-election years. So slightly weaker, but still solid performance on average over that time. That said, election years do tend to be a bit more volatile than most, especially in the lead up to that kind of summer time period when the primaries are done. For instance, the average election year since 1980 has seen an intra-year kind of peak to trough drawdown of about 17% versus 13% on average in non-election years. So just a little bit more downside volatility. Yet as that uncertainty dissipates toward getting closer to the election, as results are announced, the primaries are over, stocks tend to rally on that sense of clarity about the path forward. And a lot of uncertainty, again, you really start to see that dissipate after primary season. So once we know who's running, things settle down quite a bit in most years. The blue line here is election year returns, and the gray line is non-election year returns. When you see that overall trend is really upward starting in the summer after the primaries again, with a little volatility leading into election day and then resuming positive returns. Sometimes we get the question of whether or not we should sell once election season starts to heat up in the summer, and our answer is usually no, unless there's something specific to your situation that would warrant it. As always, have immediate cash needs on hand. That's important regardless of market conditions. But in general, buy and hold is usually the best strategy to make. We may make some changes based on a macro backdrop, but usually not due to elections. So myth number two, the markets will crash if so-and-so wins, whoever that is. Often people ask us to move to cash because they think the market's going to crash when the opposite candidate wins. The reality is that this is an emotional statement, and usually it's somebody firmly on one side of the aisle or the other. But reality is we've seen booms and busts on both sides of the aisle. The economic backdrop matters more. And we'll talk about the economy a little bit more later. While stocks tend to rally kind of in the aftermath of an election, as we saw on the prior slide, it's true, that some election years have seen bigger swings than others. Consider 2008. That's this orange line on the chart. That one kind of sticks out when Barack Obama ran against John McCain. The unfolding of the global financial crisis was really the predominant driver here rather than the opposing candidate views on war in Iraq or healthcare policy. On average, over the past 40 years, stocks have been higher after elections. This line in the middle here being election day. You can see most of the time stocks trend positively. So the last myth that might be very important, this year is the Federal Reserve is quiet during election years. We hear that one sometimes. The reality is there's probably no chance of that this year. In fact, Jerome Powell might be the least political chairman of the Federal Reserves we've had. And the Fed has a history of making a lot of moves during election years. So this year, I don't think will be any exception. You can see election years listed above, and most years show interest rates moving at least a 0.5%. And Fed movements, have a large impact on equity and bond markets. So all this being said, we get the question a lot of what do we do differently, during election years to help insulate added volatility? Well, think back to that earlier chart regarding diversification. This is the best tool in the toolkit to stay invested, spreading your assets into different areas that may not fluctuate based on an election here in the US. For example, holding bonds, if we have equity market volatility, will do the most to kind of reduce that tail risk of downside volatility in the stock market. Holding investments outside the US could help. Also, rebalancing and taking advantage of market hiccups when they happen forces you to buy low and sell high. We don't rebalance your portfolio just once a year or on a calendar basis. We look at them frequently and rebalance when certain parameters are met. We have quick dips in the market. Those sometimes can be opportunities that are short-lived. So we jump in and hopefully have a little opportunity there, to buy low and sell high. Having cash, you will need to spend this year set aside is really important. So you don't have to risk selling at a bad time if there's a withdrawal that you're going to need to take. Thanks to higher interest rates, you can do that now and still have your money working for you, earning some interest. But as election chatter builds, we expect some of the hot button issues to include government spending and the deficit, tax policy, regulation, trade, geopolitics, and we'll keep an eye on those things and determine if we need to make any shifts in the portfolio because of them. Right now, it's a little too early to tell what could happen, but we also do plan on having a special election and markets event later this year once we know more. So watch your inbox for an invitation to that event if you're interested. Speaking of interest rates, I think it's important to look at the median length of time between the last interest rate hike, which was last year in the summer, and the first interest rate cut. And that tends to be about 8 months on average. So if our last raise came in July of last year, we're due pretty soon for rate cuts to start. The market is largely anticipating this to happen in the second half of the year or even a little sooner, as we'll discuss in a couple of minutes. The question is what could this mean for equity markets if rate cuts start to happen? The dotted line is the date of the last rate hike in all of the scenarios that are shown in this slide. And then each line shows the growth of the S&P 500 leading into that last rate hike and then leading out of that last rate hike. So leading into it, you can see that the markets are largely flat, maybe even slightly negative. And then after the rate hike stops, it's mostly positive from that point forward. For equity markets, the first 6 months following the conclusion of a hiking cycle have typically been positive, which is what we saw, especially in the last quarter of last year. But what people forget is these economic changes from rate hikes take a long time for the full effect to kind of make its way throughout the economy. So weaker earnings growth for companies are still likely to come in the future. We've seen a little bit of that in this first quarter earnings season. It's been mixed. But equity markets are always very forward looking. So valuations usually get a boost when we hear of a less restrictive stance from the Fed. Have you ever heard the term "don't fight the Fed"? That's kind of what this means. When rates start to come down, this is generally very positive for equity markets. This chart shows several different time periods after the Fed stopped hiking rates, what the market did going forward. And in only one scenario was the market lower 2 years later, and that was during the tech bubble recession. But the road isn't extremely clear. It will continue to depend on the economy and how long rates remain high. So now that we have a better idea of what happens to equity markets after peak interest rates, what happens to bonds? This is the exact same chart, but instead of the S&P 500, it's Treasury bonds. When it comes to bonds, the path is a little more clear when you look at history. Leading up to that last rate hike, which again is this dotted line, returns are essentially flat for bonds. And then after that last rate hike, treasuries have returned positive performance and good returns at that in all of the scenarios that you see on the chart 2 years after the last rate hike. So going forward, it's important to make sure you still own bonds as they're paying us a great interest rate now, and the path forward looks a lot more clear. So what is that clear path? Well, the markets are again expecting some rate cuts by the end of the year, like I mentioned earlier. But unlike last year when they were also anticipating rate cuts, and I didn't think that would happen, this year I do think we will start to see some rate cuts. The market has priced in some aggressive rate cuts this year, which is why bonds performed so well in the last quarter of last year. Inflation and economic activity are kind of the wild cards that drive the Fed's decision. If the US economy starts to struggle unexpectedly and we don't get and we do get a potential recession, then rates could get cut quickly. But if there is no recession and inflation proves stickier than anticipated, we could still have higher rates for longer. So it may this kind of a chart, it may not start to creep back down. We may not start to see rates creeping back down in that scenario. So this uncertainty is really what's driving our bond positioning still. We've continued to hold some shorter duration strategy in that area of our portfolio. Interest rates are still very attractive at the short end of the curve, meaning that we're getting paid well to stay there. The risk remains low. But I anticipate we'll unwind this at some point this year as we get closer to a clearer path in rate cuts. So it's kind of what we're thinking on the bond side of things. Cryptocurrencies. I think people love to talk about this topic. There's been a lot going on this year. Cryptocurrencies now have an ETF tracking the performance of many of them. This makes it easier in theory for the average person to invest and capture the return of cryptocurrencies in their portfolios. We've seen a lot of money flooding into those ETFs. And we've gotten questions not only now, but over the years on Bitcoin and other cryptocurrencies. It's interesting if you listen to Jamie Dimon, who's in the leadership at JP Morgan, he thinks they're a worthless Ponzi scheme. And Vanguard's come out with the opinion that they'll never buy or issue an ETF related to cryptocurrencies. But the SEC allowing the ETFs on the exchange is kind of one small step closer to legitimacy for cryptocurrencies. In my opinion, these investments are still on the bleeding edge. And what do I mean when I say that? Well, I mean it's as likely to succeed as it has the potential to fail. Essentially, it's gambling right now. It's for the risky investors. If you allocate any of your investments to this, make sure it's money that you can afford to lose if these end up disappearing, or if you're doing it via wallet and your wallet gets hacked. I think it's worth mentioning here. As kind of a public service announcement, we've had we've heard some people being conned out of Bitcoin, people getting reached out to over social media asking for them to send them $10,000 in Bitcoin and they'll invest it in other strategies for you. And just know that those can potentially be a scam. We've personally heard of 2 individuals getting scammed out of this money over time, the last few weeks. No legitimate company is going to reach out to you over the normal course of your day over social media and ask you to send them this kind of transaction. So if you ever are approached and have a question, please reach out to us first and let us just do a quick, pulse and see if it's a legitimate ask or if it might be kind of a criminal in disguise. I mean, we all love the lure of a high sounding potential return. It's exciting, and criminals know just what to say to get you excited about an opportunity. But let us do some research first. We're happy to do it, and it won't hurt. As of now, I think we see clients looking for these opportunities, but it's not something that Raymond James allows us to own within your accounts here. They're reviewing this area, whether it be the cryptocurrencies or the ETFs, to understand more about those assets, but their policy remains unchanged, prohibiting it. We don't know, for the ETFs, what tax consequences are of these ETFs. Will they be able to successfully track the performance of cryptocurrencies at all times? They're simply untested yet. And when the bare necessities of an orderly market are unknown, we're going to stay away from it for a little while. So we have some other exciting changes coming this year that don't happen all that frequently. It's really worth mentioning, if you think all the way back to 1994, prior to 1995, it used to take 5 business days for a trade to settle. Um, can you imagine, selling and not having any access or potential access to your funds for over a week? That's where it was back then. In 1995, that was reduced down to 3 days. Then in 2017, the SEC shortened trade date settlements down to 2 days. And now we're taking that last step to shorten it down to 1 business day. That'll happen in May, and this applies to your stocks, your bonds, your exchange traded funds, your mutual funds. And you shouldn't notice any impact to your situation other than you can get your money faster if we have to sell something for you to take a withdrawal. This is indicative of better technology, decreasing the amount of time it takes to accomplish something, and in general is a good thing. Markets are more efficient, fewer hands need to touch something, which reduces the costs and propensity for error. So let's jump into an economic update. I've got a few brief slides on this. The question still is on everyone's mind, will there be a recession in 2024? Well, the technical definition of a recession is 2 negative quarters of GDP growth. And this actually occurred back in 2022, if you remember. However, at that time, the National Bureau of Economic Research never called a recession here in the US. And the main reason for that was continued strength of the consumer and the job situation. And that persisted throughout 2023. This chart is a picture of consumers in a few different ways. But what it's saying is that income, employment, and spending is still growing for the consumer, and that isn't consistent with recessionary times. The only factor, in fact, that we see contracting is industrial production, all the way to the right of your screen, is slightly contracting, which makes sense because right now the consumer is still revenge spending on services rather than on goods. So one key impact of higher rates by the Fed is the housing market and mortgage rates, and that has a big impact on consumers. So while mortgage rates have doubled, more than doubled, the dark blue line in the chart, the increase in what American homeowners must pay on their mortgage, their effective rate, or the light blue line here, has been relatively small. This is because most of us have fixed rate mortgages. The impact on homeowners' ability to pay their mortgages has been minimal because of this. So think about it. If you have a mortgage locked in at 3%, does it matter to you if the Fed is raising interest rates? I mean, for renters, the story is different. Landlords have taken advantage of higher rates as a reason to increase rents. So those that don't have locked in a low mortgage or are homeowners have felt the full impact of higher rates on their wallets. So just to put this into perspective, it's about 34% of households in the US that are renters. So that's who is impacted the most here. Now let's take a look at inflation. This page shows both the headline, which is the light blue line, and core, which is the dark blue line, consumer price index over the last 50 years. Core CPI just excludes food and energy prices, so it's a little less volatile number. And if we look at these two lines, looking at both of them, allows us to see trends over time versus kind of their long run averages. This dotted line here is the long run average. And you can see that inflation has come back under control again, but still has a little ways to get back to the Fed's target of 2%. So rates may stay higher for longer. so that we ensure that this downward trend continues. And that's what the Fed just indicated at their recent meeting. Lastly, unemployment, it remains very low still, below 4%. And this is significant because this is the second kind of metric the Federal Reserve pays attention to. Unemployment staying so low, even after rate increases, has given the Fed kind of lots of room to hold rates steady at these higher levels if they need to, in order to keep fighting inflation. I think we start to see unemployment ticking up this year. We're seeing kind of an acceleration in layoffs, buyout packages being offered by more companies. And the more you see doing this, the more companies will do it, kind of following the crowd. So just some final comments. Our investment committee and department, we remain focused on proactive decision making and rebalancing to try to make changes, whether it be during calmer times or more volatile times in the markets. We remain disciplined in our commitment to diversification. This is unchanged over our nearly 40-year history of our firm. We've helped hundreds or probably well over 1,000 clients accumulate and plan for a variety of goals, life transitions in all types of markets, even down ones. And we'll continue to be here for you. Now I'd like to hand things back over to Lauren and also bring Michael in for discussion on some of the financial planning items.
Thank you, Angie, for sharing that analysis of where we've come and what might lie ahead. As center clients, you'll have the opportunity to hear more from Angie throughout the year through newsletters like our investment commentary and timely videos to get our latest takes on the financial markets. So the focus of today is on the investment landscape. But hopefully you've learned by now that at the center, we don't believe that investments can be viewed in isolation. It's the combination of investment management plus financial planning that can ultimately deliver those great results. And there have been some important updates on the financial planning side of things. So now I'd like to introduce you to one of our partners and senior financial planners, Michael Brocavich, to share these updates and how we expect they may or may not affect clients. Michael has a long track record in the advising space at various financial service companies. Remember earlier when I talked about our great workplace and how it might allow us to attract top talent? Well, Michael was a partner at another financial planning practice, but ultimately was attracted to the unique workplace and mission we built here at the center. He decided to join us in 2021, and we were so excited to invite Michael to become a partner this year. He serves as our Director of Financial Planning, in addition to working directly with clients as their advisor. Welcome, Michael Brocavich.
Thank you so much, Lauren. And Angie, thank you. That was an excellent presentation and a lot of really good information. But as Lauren mentioned, we're going to shift gears a little bit and go away from talking about investments and focus more on some new enacted legislation, because there's been a lot of changes, not only on the retirement savings and how retirement savings is distributed, but for those of us that are in Michigan, there's even some changes to how those retirement distributions will be taxed for you. So the first thing I want to touch on is the Secure Act 2.0. So what is Secure Act 2.0 and where the heck did this thing come from? So at the end of 2022, Congress approved an omnibus bill. And part of that omnibus bill was the Secure Act 2.0. All right. This bill is in addition to the Secure Act, which was passed back in 2019. The Secure Act passed back in 2019 focused more on beneficiaries of IRAs and how wealth would be transferred from generation to generation from retirement plans, where Secure Act 2.0 really focuses more on retirement planning, all right, and being able to have more access to retirement savings for individuals. So SECURE stands for Setting Every Community Up for Retirement. And like I mentioned, the intention of this bill is to expand access to retirement savings for the general population. This Secure Act 2.0 focuses more heavily on employer-sponsored plans such as 401ks, 403bs. It even focuses on for you small business owners out there that might have simple IRAs and SEP IRAs, some changes there. So one small example under Secure Act 2.0, part-time employees are going to be allowed to save into retirement plans more quickly. Also, some employers will be required to automatically enroll employees in retirement plans and increase their retirement savings each year. Now, going through this Secure Act 2.0, we can't go through all the provisions today because I'm going to be honest, there's over 100 provisions of this act. So what I would like to do is just focus on some of the things that we feel like are going to be impactful to you. So as you guys can see on this slide, what has made Secure Act kind of a different act is all these 100 provisions that I was talking about, they're actually going to be implemented over a number of years. So you might be saying, well, if this was approved in 2022, why didn't I see a lot of changes in 2023? Well, to be honest with you, not very many changes occurred in 2023. A big chunk of changes are actually starting now in 2024. And so these are going to be changes that we want to make sure that that we're conscious of, as well as talk about some changes that are going to be coming up in the very short term here. So one of the most important changes out there especially for those of you out there that are retired, is the changes to the age of the required minimum distribution age. So this is your RMD, or this is the distribution that everyone is required to take at a certain point out of their retirement accounts, whether it's an IRA or a 401k. In the past, folks have had to start these required distributions at 70 and a half. And I'm sure there's a lot of you that are out there that, maybe you are turning 70 and a half this year, and you're saying, wait, don't I have to start my distributions? Well, the Secure Act, the original Secure Act, actually pushed those required minimum distributions to 72 for folks. So people have been had the grace period up until 72 before they needed to start these distributions. Secure Act 2.0 actually takes it a step further and moves that distribution to age 73 for people that were born in 1959 and earlier. And then for folks that were born in 1960 or later, your required minimum distribution is actually not going to start till you're age 75. So that gives folks a little bit more time in retirement before they have to start to take these required distributions. Another important provision of the Secure Act 2.0 that affects your RMDs is the penalty that the IRS can assess if for some reason you miss taking your required minimum distribution. So in the past, that penalty was 50% of your required distribution. So for example, if you had a $10,000 required distribution and you forgot to take that, the IRS could have imposed up to 50% penalty, which would have been $5,000. Now that penalty has been reduced to 20%. And if you catch your error and you're able to fix it quickly, the IRS is willing to only impose a 10% penalty on that error. So that really helps with folks that are needing to take required minimum distributions if for some reason that by some error you did not get that distribution taken care of. Now, some more changes that came from the Secure Act 2.0, and a lot that, us as planners and, me personally am pretty excited about is really focusing on ways for investors to get more money into Roth IRAs. So historically, it's been a challenge for investors to get money into Roth IRAs. I mean, you've had to choose, all right, do I want to not pay taxes on my retirement contributions today? And exchange it for paying taxes once I retire? Or do I want to pay taxes on this stuff and put it into a Roth IRA to where in retirement I don't have to pay taxes at all when I take it out? So we've had to make these decisions as we've come up with our financial plans. And also for some folks out there, you contributing to a Roth IRA, you're capped if you make too much income. So if you make above 218,000, Joint filing, you may not have ever been able to contribute to a Roth IRA. So some provisions that are now available starting in 2024. One is going to be 529 to Roth IRA transfers. So this is one that I'm particularly excited about because folks out there that have 529 plans, that maybe your student didn't use all those funds for college. Either you oversaved into the 529 plan, so there's some extra money left after they get out of school, or maybe scholarships were incurred, and so you didn't need to use all the money that you have saved in a 529. Well, now there are provisions that allow you to make transfers out of your 529 and into a Roth IRA. This provision will allow you to move up to $35,000 out of a 529 plan into a Roth IRA. You can move these, you can't move this money all at once. For example, you wouldn't be able to move 35,000 in 1 year into a Roth. You'd have to do it over years. You do it by moving your Roth IRA contributions that you would normally make to your Roth. Instead of taking it out of the cash or out of your earnings from work, what you can do is take money out of your 529 and do a tax-free transfer from your 529 into your Roth IRA and make your Roth IRA contributions for that year. Another pretty big provision that the Secure Act 2.0 brings is that folks that are higher earners, all right, will be required to have catch-up contributions go to a Roth IRA. All right. So for folks out there that make over 145,000, if you are making catch-up contributions, those contributions will be required to go to a Roth rather than go into your pre-tax account. Now, some of you might be thinking, oh my gosh, that's not happening for me right now. Am I doing something wrong? No, you are not. So as you can imagine, there are some complexities to this provision. It was supposed to start here in 2024, but the IRS has decided to delay this until 2026. This gives employers plenty of opportunity to be able to implement this change. And it also gives folks out there the opportunity to meet with their planners to decide, all right, now that once this change occurs, how should I change my retirement savings, if I should change it at all? Another provision that's going to be able to allow folks to get more money into Roth is that employees can now elect an employer to put their matches as a Roth contribution. So in the past, if an employee wanted to contribute to their Roth portion of their 401k rather than their pre-tax portion of their 401k, previously you would put your contributions to the Roth and your employer would give the matching contributions to your pre-tax side of your 401k. With the new provisions, employees can now ask their employer to put their matching contributions into the Roth part of their 401k rather than their pre-tax 401k. Now, you're going to want to make sure that you understand how this could change taxes, because previously those matching contributions, you did not have to pay tax on those contributions because they went into your 401k pre-tax. Now, if you're asking your employer to put that into the Roth side of your 401k, there would be some taxes that you would need to pay on those funds, because Roth contributions are after-tax contributions. Lastly, for those small business owners out there or sole proprietors that are maybe saving with SEPs or simple IRAs, in the past, you've been kind of pigeonholed where you only have been able to save pre-tax money into into simple IRAs and into SEP IRAs. You now are able to put some of those contributions into a Roth simple IRA or a Roth portion of a SEP IRA, allowing for some more Roth savings there as well. Next, I want to quickly mention a couple other provisions that are strongly tied to inflation. I know that inflation has been a very hot topic the last couple of years. So some changes that they've implemented that involve inflation, for example, are going to be the IRA catch-up contributions. So for those of you that are age 50 or over and you've been contributing to IRAs, Roth IRAs, you've always had kind of the same catch-up contribution. You know, for people that are over age 50, if you contribute to an IRA, you can contribute up to $1,000 a year extra. Well, that $1,000 has always been the same for years. It's always been $1,000. Well, now they're going to start to increase that $1,000 for inflation. So each year, that $1,000 mark is going to get a little bit higher and higher, just like your IRA contribution amounts increase every year. Your catch-up contribution will now start to go up as well, allowing people to save more into IRAs. The next provision I want to talk about here will be important for those between the ages of 60 and 63 that are working and contributing to their employer-sponsored plans. Once I just explained earlier how over age 50, folks are able to contribute more to retirement plans. This new provision now says, all right, once you get to age 60 to 63, you get kind of a super step up, catch up in contributions. So you can add an additional $10,000 on top of what you are already saving to your 401k, 403b plan. All right. So previously, if you were maxing out your 401k under the current provisions, you were able to save up to $30,500. Now, with this extra $10,000, folks between 60 and 63 could save up to $40,500. So this additional $10,000 catch-up will be really important for folks that are trying to get more retirement savings in before they actually get to retirement. So at the beginning of the presentation, one thing that I talked about is the Secure Act's intention was to allow for greater access to retirement savings. And a huge barricade that a lot of younger investors have gotten to from being able to save more into their 401ks and their work retirement plans is they have to pay off their student loans. So a new provision now says that payments to student loans are also considered elected deferrals. So if a student in the past was having to decide, do I pay my student loans or do I put money into my employer plan? Well, now, since student loans count as elected deferrals, employees are able to benefit from an employer match in their retirement plan with actually not even putting any money into their retirement plan. So they could pay off their student loans and still get the match into their 401k as if they were contributing to that plan. Another notable change for surviving spouses is how they can elect their RMDs based on age. All right. So historically, when one spouse passed away, their surviving spouse was able to just take over their IRA, and they would then assume required minimum distributions based on their own age, so the age of the surviving spouse. But now spouses are able to actually choose if they want to do their RMDs based off of their age, or if they want to do RMDs based off of the deceased spouse. So why would I want to make that change? Well, one reason you might want to do that is if you have a deceased spouse that you inherited their IRA and they were significantly younger than you were. In that case, their RMD at their younger age might be a lot less than the required minimum distribution would be at your current age. So this is just kind of a planning opportunity that you can have where you can really make a choice on how you want those required minimum distributions to come out of an inherited IRA that you received from a spouse. Now, the last slide I want to go over here is going to be directed at our Michigan clients. So for folks that live in Michigan and file a Michigan state return, this is a fairly significant change in how Michigan will tax your retirement distributions. So in March of 2023, the Michigan House passed the Lowering Michigan Costs Act, or what's more formally known as the Public Act 4. All right. Now, within this act, what it allows for is retirees that receive income from pensions and 401ks and 403bs. So those pre-tax retirement accounts that they've been saving money to. This act allows for those distributions to get some tax relief. So in a sense, what people are able to do is if distributions from those retirement accounts, they're able to deduct that off of their tax returns. So they do not have to pay taxes on either a portion or eventually 100% of those retirement income distributions. So for those of you that were out there that were born in 1945 and before, you might be saying to yourself, well, this already has been occurring for me. And you're absolutely correct. You know, for the last decade, you guys have been able to have a full deduction amount for that retirement income. And I want to tell you that nothing is going to change for you. You will still be able to get the 100% full deduction amount that you have been getting so far. So you no need to worry that changes will be made for you. Well, the changes that are coming are for those folks that are a little bit younger than that. So folks that were born in 1946 and beyond. So as you can see from this chart, the deduction of the retirement income that you're able to get is going to be progressive and it's going to increase over the next few years. So in 2023, you're able to deduct about 25% of that income. And now in 2024, you're able to deduct 50% of that income. Next year, it'll be 75. And then in 2026, you'll be able to deduct the full amount, getting the same tax advantages that folks born before 1945 are able to enjoy today. Now, I do want to highlight a couple exceptions to this. So one, if you have a retirement plan that's a 457, or also known as a deferred comp plan, distributions out of those plans would not qualify for this. So those you would still have to you'd still have to pay full Michigan state tax on. Also, for those out there that are public police officers, firefighters, county correction officers, state troopers, you folks actually do not have to wait till 2026 for this to be 100% deductible. You're able, starting in 2023, to get this full deduction. So it really is going to help some Michigan retirees be able to save some money on taxes over the next few years. If you have any questions on this, we encourage you to reach out to us, reach out to your planner specifically, and see how these changes may impact you and your financial plan.
Thank you, Michael, for that timely overview. I know many of our clients have been wondering about all the legislative updates and how it may or may not affect them. So our team of planners looks forward to addressing how the investment outlook that Angie provided and the legislative changes you heard today from Michael will affect you personally when we see you next. Thank you all for spending time with us today and for your continued trust and confidence in all of us at the center. We'll see you soon.